It's 11:14 at night. You're in bed, phone in your hand, your banking app open. The number's right there. $127,000. You stare at it for a bit. It's not small. Took years to get there. But something feels off, and you can feel it even if you can't quite explain why. It's not fear of losing it all. It's something else. It's that feeling that you don't really know what that number actually means. Whether it's enough, whether it's growing the way it should, whether you're on the right path, or just moving. You close the app, but the question sticks. Here's what nobody told you. Every level of wealth comes with its own rules, its own traps, its own specific mistakes that look like smart decisions until they're not. And most people only know the stage they're in. Not the next one, not what comes after, just their own. You've got $100,000 saved. That already puts you ahead of about 60% of Americans over 50. The average 401k balance in that age group is $127,000. You're in the game. But $100,000 using the 4% rule gives you about $333 a month in passive income. $333. That doesn't cover rent, doesn't cover your car, doesn't cover health insurance. Here's the first rule at this stage, and it's counterintuitive. The problem isn't how much you have, it's how much you're losing without realizing. Credit card interest at 24% a year, a car loan at 7%, an adjustable rate mortgage that's gone up 3 times since 2022. You spread your money across 11 different funds and think you're protected. You're not. You're diluted. You've got exposure everywhere and conviction nowhere. What you're supposed to do at 100K is simple. Not easy, but simple. Max out your 401k up to your employer match. That's an instant 50 to 100% return on your money. Nothing in the market gives you that. Then get rid of any debt above 7% interest. Every dollar you put toward a 24% debt earns more than any stock fund over the long run. You're not building wealth here. You're setting up the conditions that make wealth possible. There's a difference. And if you don't get that, you'll hit $250,000 with the exact same problem you had at 100, just bigger. You just crossed $250,000. The system shifts now. Most people don't notice. $250,000 throws off about $833 a month using the 4% rule. That's real money. You start to feel like you've got a foundation, and that's exactly where the problem shows up. Because 250 is the most psychologically dangerous stage in the whole journey. Not because the market is riskier here, but because you start to slow down, you stop contributing aggressively, you've got a solid base, your attention drifts, and that behavior, that 3-4 year pause between 52 and 56 costs, on average, an extra $180,000 in your final net worth. Not from losses, from compound interest that never got the chance to work. This is where the stuff most people ignore starts to matter. Active asset allocation, not passive. A Roth conversion ladder gradually moving your traditional 401k into a Roth IRA during lower income years before 63, so you pay less tax on the money you'll eventually pull out. And then there's sequence of returns risk, the one nobody really explains well. If the market drops 30% in your first year of retirement and you're pulling money out at the same time, the damage isn't temporary, it's permanent. A portfolio that should have lasted 30 years can end up lasting 17. That's not theory, that's sequence math. Second rule of this stage, speed matters more than direction. It's not where your money is going, it's how fast you're getting there. An extra $500 a month between 52 and 60 is worth more than $120,000 invested at 65. Time is the one resource you can't buy back. And you just crossed the point where that starts becoming true in a way you can't undo. 500,000. For the first time in the journey, the number actually covers something real. About $1,667 a month in passive income, above the federal poverty line, close to what a part-time worker earns in the U.S. You look at that number and feel something different. Not relief, more like recognition, like the system finally nodded back at you. But here's what almost nobody at 500,000 does in time. There's a decision most people keep putting off, and it's not about where to invest, it's about when to start moving the money. Your traditional 401k is going to be taxed as ordinary income when you withdraw it. The rate depends on your bracket, but for most middle-income Americans in retirement, that's somewhere between 22 and 24% on every dollar you take out. The Roth IRA backdoor systematically converting money from your traditional 401k into a Roth during lower income years is what protects a big chunk of that wealth. But it only works if you start before 63. After 63, IRMAA kicks in the Medicare income-related monthly adjustment amount. If your taxable income goes over certain thresholds, your Medicare premiums go up automatically, in some cases by more than $5,000 a year. Tax loss harvesting becomes part of your routine, selling positions at a loss to offset taxable gains and reduce the hit from dividends and rebalancing. You're not just accumulating anymore. You're managing. Third rule of this stage: the money you don't lose to taxes is money you don't have to earn in the market. $500,000 is the real turning point in the journey. Not because it's enough, but because from here on out, tax decisions matter just as much as investment decisions, sometimes more. And there's one specific decision people at this level almost always delay. We'll get to that in the next stage. $1 million. That's the number everyone talks about. The one in headlines. The one that's basically become shorthand for "you made it." About $3,333 a month in passive income, above the median U.S. income. For most families, it covers the essentials with some room to breathe. And here's the decision you've been putting off since $500,000: when to start converting to Roth. If you're hitting $1 million with most of your money in a traditional 401k or traditional IRA, you've got a tax problem that's going to grow, not go away. At 73, the IRS requires you to start taking minimum withdrawals from your 401k. They're called required minimum distributions, or RMDs. The amount is based on your total balance, and it's taxed as ordinary income, right at the top of your bracket. With $1 million in those accounts, your first RMD could be $40,000 or more. Add that to Social Security and any other income, and you could get pushed into a higher tax bracket than you ever paid during your working year. And IRMAA shows up again, higher. More expensive, a systematic Roth conversion starting around 58, 59, 60 spreads that tax bill over lower income years. Instead of paying 28% on a big withdrawal later, you might have paid 12% on smaller conversions over a decade. That difference can add up to $200,000 or more in total taxes over retirement. But there's another risk. $1 million doesn't eliminate sequence of returns. If you retire at $1 million and the market drops 35% in your first year like it did in 2022, like it did in 2008, and you're withdrawing 4% at the same time, the math changes. A portfolio that was supposed to last 30 years might not make it to 20. Fourth rule: hitting $1 million without a withdrawal strategy is just as risky as never getting there. The number isn't the destination. It's the start of a whole new level of complexity. $2 million, about $6,667 a month in passive income. More than the median full-time salary in the U.S., generated without you having to do anything. At this point, something shifts in how you relate to money, and that shift is harder than any financial decision you've made so far. You stop being a saver. You become an asset manager. The problem isn't accumulation anymore. It's preservation, tax efficiency across generations, and protecting against the risks money creates, not the ones it solves. The mechanics change completely. A revocable trust keeps your assets out of probate and passes wealth on without going through a public process. A stepped-up basis wipes out the capital gains built up over your lifetime. When assets are inherited, your heirs receive them at current market value, not what you originally paid. This isn't planning for your kids. It's planning so your kids don't lose 30% of what you built to taxes and legal fees. A well-structured $2 million portfolio isn't managed by you day to day. It's managed by a written set of rules, an investment policy statement that defines target allocation, rebalancing rules, withdrawal guidelines, and review triggers. You're not making emotional decisions about money anymore. The money has rules. The rules make the decision. And here's the cost nobody really says out loud. You're not entirely sure who you are outside of this anymore. For decades, the question was, how much do I have? Now the question is, what is this for? Who is it for? How long does it need to last? And what level of risk can I still tolerate, not financially, but existentially? That's not something a number can answer. $2 million gives you financial freedom. What you do with it, that's a different journey. Now you see the pattern. It's not about the numbers, it never was. It's about what each number demands from you. At 100K, the system demands discipline. You cut what's bleeding and maximize what compounds. Your identity here is the builder. At 250, the system demands speed. The foundation is there. Now the risk is slowing down at the wrong time. Your identity here is the athlete in race mode. At 500K, the system demands tax strategy. You can't treat money like just a number on a screen anymore. It has structure, it has cost, it has consequences over time. Your identity here is the architect. At 1 million, the system demands an exit plan. Not from the market, from the accumulation phase. How you take the money out determines how much you actually keep. Your identity here is the strategist. At 2 million, the system demands governance. Rules that work without you. Structures that protect the wealth from you. Your identity here is the manager. Here's the core realization. People don't fail at each transition because they lack money. They fail because they try to use the mindset from the previous stage in the next one. The builder who reaches 1 million still thinking like a builder keeps accumulating without a withdrawal strategy. The athlete who hits 500K without becoming an architect ends up overpaying in taxes. Every stage requires you to let go of the identity that got you there. That's the system. And it doesn't explain its own rules. It's 11:14 at night. You're in bed, phone in your hand, your banking app open. The number's right there, $127,000, but now you know what it means. You're in the builder stage. The rules here are specific. The mistakes are predictable. And there's a way forward. It's not fast, but it's clear. What you don't know yet is which version of you the next stage is going to require, which identity you'll have to let go of, which belief that worked up to this point is going to turn into the exact thing that holds you back in the next one. But that comes later. For now, the number's right there. And the system, whether you understand it or not, keeps running. The question was never if you were going to be part of it. It was whether you'd understand the rules in time. You close the app. But this time, the question feels different. If you liked the video and it added something for you, go ahead and hit like. And if you want to be part of this community, make sure to subscribe to the channel. I'll see you in the next video. Take care.